Welcome back. The market's doing just fine. Let's put the focus on ratings for India Inc. Into FY25. Jitin Makkar, Senior Vice President and Head of Credit Policy at ICRA is joining us. And so at CRISIL Ratings. Gentlemen, good morning. Great to have both of you here, Jitin and Som. Prashant, this side. Som, if I can start by sort of asking you, I was looking at, your upgrades to downgrades ratio for the second half, which is moderated a little bit, but still, as you in your report point out, remains pretty strong or elevated, as you put it. Can you start there, what you've seen in H2 of FY24, and then take us into what your expectations are for FY25?
Thanks, Prashant, and good morning. In H2 of fiscal 24, we saw 409 upgrades in our portfolio, vis-a-vis 228 downgrades. And that has translated into a credit ratio, which is nothing but the upgrades to downgrades ratio of 1.79 times. And this is a tad lower than what we saw in the first half of 1.91, in line with what we had outlined earlier. Primarily driven by the domestic demand and the government-led capex, domestic consumption and the government capex were the primary drivers for this. And sectors which clearly saw a lot of upgrades were the infra and infra-linked sectors, including construction, renewable power, road assets, and even real estate. The downgrades were a little bit higher on some of the export-linked sectors that included textiles and seafood, primarily because of the subdued global demand and higher cost inventory, which impacted profitability in some of the segments. Coming to the outlook for next fiscal 2025, we continue to have a positive credit quality outlook, and we expect upgrades to outpace the downgrades. And again, the primary reasons would be the steadfast domestic demand, the low corporate leverage levels that we have, as well as the tailwinds from the ongoing, as well as what we have seen in the past, the infrastructure build-out that the country has undertaken.
So just one point, when we talk about this upgrade-downgrade ratio, we're looking at the number of number of rating actions, right? Is there any way to sort of quantify this or qualify this as sort of value add or representation in the economy? This metric, which perhaps gives us a better idea of, we outlined some of the sectors where the bulk of the upgrades and bulk of the downgrades have happened. But if we were to sort of look at contribution to growth, would you say the number actually is, this number is even better as compared to the 1.79 that you pointed out?
So we also track something called as a debt-weighted credit ratio, where we don't look at just the number of companies where we saw upgrades or downgrades, but also the debt which is sitting on the balance sheet of the companies. And there the ratio came in at 1.28 times, somewhat lower than what we saw in the first half of this fiscal. But first half was more of an aberration, where we saw a few companies with very large debt that got upgraded. In the second half, there was no such skew. But nevertheless, in terms of even quantum, the quantum of upgrades to downgrades is also higher. Also, when I shared my outlook here, we used a framework called COIN framework, where we looked at 26 corporate sectors and 12 infrastructure sectors, and these together account for almost 72% of the rated debt in the companies, excluding the financial sector, and hence it is fairly representative. And what we do see is 21 out of the 26 sectors we have a strong to favorable credit quality outlook, and these account for almost 96% of the debt which we have where we are undertaking the study.
Okay, Jitin, let me get you into the conversation as well. Sort of look ahead into FY25. From an equity perspective, general chatter has for some time has been that we find ourselves, corporate India Inc., after all of the deleveraging, etc., which has happened, finds itself in the pink of health as we enter FY25 as well. Maybe, this week we have the RBI meeting and nothing will happen, but the next step, whenever that happens, is going to be a cutting kind of a cycle, hopefully, not just here, but globally as well. In that context, just sort of tell us, what's the outlook for for what you rate, the debt that you rate across sectors into FY25?
Yeah, hi Prashant. Good morning, everyone. Before I specifically answer the question that you've asked, Prashant, I'll just give you an additional context based on what we were seeing in FY24, and that again in the context of the larger period historical trend of the past 3 years. So FY24 indeed was a year where the upgrades outnumbered downgrades by a factor of 2. But there's another side to it, which is that FY24, at least what we were seeing, was that it was a year of normalization in terms of credit quality. By that, what I mean is that this was a year where we saw the reaffirmation rates, the rating reaffirmation rates to align with the historical average of around 80%, which means that 80% of the entities in our portfolio saw the ratings getting reaffirmed. And it was only in the 20% pie that we saw ratings change. And within that 20% pie where we saw a rating change, there were 2 upgrades for every downgrade. So this is unlike the situation which was there in FY22 and FY23 post the pandemic rebound, where industry-related factors were contributing to a big tailwind, and there were a lot of upgrades in FY22 and FY23 because of that. Now, coming to FY25, if you have to pick up a few sectors where trend lines may continue, so there's a recency effect relating to, say, the hospitality sector, which has been seeing a good uptick in FY23 and FY24, and we expect FY25 also to be a good year for the hospitality sector. So I think momentum should continue for the hospitality sector in FY25, and infrastructure sector, whether it is roads or railways or defense-related entities, they may see the benefits of their high order book to OI ratio, which is currently running anywhere between 2 to 3 times for many entities. So whether we talk about these conventional infrastructure pockets or the new age infrastructure segments like data centers, I think FY25 is again going to be a good year from a credit standpoint for these segments as well.
And on the flip side, Jitin, any sectors on the other side?
Yeah, on the other side, again, the export-oriented sectors are still not out of jail. We expect that the cut and polish diamond segment, which is again it's a labor-intensive segment, so there could be challenges on that aspect as well. Plus, we are seeing export momentum to be not as rosy as yet for other segments like the textile sector. There again, we expect sequentially the improvement to be there in FY25. But again, the kind of capacities and the fixed costs that many of the entities in these sectors have built up, that may take a while for the revenue growth to be at a level where the profitability returns to the FY22, FY23 levels. Other than this, agricultural commodities like tea, there again, there could be certain challenges there. And I mentioned about tea, cut and polish diamond sector, textiles. Some bit of sequential moderation would be there in the ferrous metals also. Not that the sector is going to be bursting at its seams, but we do expect that the debt by EBITDA ratio of this sector to trend towards 2.5, 3x times compared with the lows of 1x that it had seen in FY22.
Yeah, no, got that. You know, Som, on chemicals, which is, you've identified that as one of the sectors which are facing some headwinds. In the listed universe, we saw a very large player about a month ago seeing a rating downgrade. Could you talk to us about that particular space? I mean, could there be a turnaround in FY25 for the sector if you want to just sort of dig in a little deeper there?
So, as per a study, there were 4 sectors: specialty chemicals, agrochemicals, cotton spinners, and diamond polishers, where these were sectors which were facing headwinds. Given that they are largely aligned with what is the global macroeconomic conditions. What we are seeing is for 3 of them, barring diamond polishers, for the other 3, we are expecting a partial recovery of sorts in fiscal 25, even though it will still be subject to some of the pressure which was there, but it may ease a little bit. Having said that, all these 4 sectors do have fairly strong balance sheets, and hence from a credit quality outlook perspective, the outlook for vast number of companies in these sectors is likely to be stable to moderate.
Got that. What about real estate, Som? I mean, any specific trends there? I mean, that's one sector which is really compared to a couple of years back. I mean, actually just a couple of years back, a complete turnaround, right? sea change.
Yeah,
How is
clearly,
that expected to hold out? Yeah.
Yeah, clearly, you're right. I mean, residential real estate sector is riding on buoyant consumer demand, and inventory levels are also at much lower levels compared to what you have highlighted. 2 3 years back, they used to be around 4 to 5 years of sales in major cities. Now it is trending more towards closer to 2 2.5 times, 2 years. So very clearly, residential real estate, the fortunes are much better, and it's amongst the sectors where we've seen more upgrades, and we continue to see buoyancy here. Commercial real estate continues to remain steady, in terms of credit quality outlook.
Jatin, any other sort of anything else which strikes out to you, which you'd like to highlight for our viewers as we head into 25?
Overall, we think that there are many sectors which have done well over the past 3 years, but are yet to see the post-pandemic path. So whether we look at cement or steel or automobiles, whether passenger vehicles or commercial vehicles, I think among one common thread that runs across these sectors is that they've done well over the past 3 years. But if you were to compare the performance of these sectors in terms of volume growth, with the anchor being FY19, which was the pre-pandemic year, then we would see that the progress or the growth that these sectors have seen in terms of volumes, it is yet to achieve that pre-pandemic path. Real estate sector has been one exception, in the sense that when we look at the CAGR since FY19 for real estate sales in terms of millions of square feet of residential real estate sale in the top 7 cities in India, that growth number would be anywhere in the vicinity of 12 to 15%, which on a CAGR basis is a very promising number. So yes, there are still several sectors where capacity expansion has been taking place, the likes of chemicals or steel or cement and the likes, so which means that over an extended time horizon, which would be in the next 3 to 5 years, these sectors should achieve that pre-pandemic path. It has been slow, but it should achieve over the medium term.
All right, we'll leave it there for now. Jatin and Som, great to speak with both of you here on CNBC-TV18 this morning. More green than red, as we say in market parlance, and generally looking pretty upbeat as we head into FY25 on the credit rating side. So that's the word coming in from CRISIL and ICRA.